Hello, everyone. Welcome to NSS Mentorship and Online Classes. I am Mohamed Sisi, your tutor and your mentor. Today, we are going to focus on the conceptual framework. I have already covered tutorial on the introduction to financial reporting, which is very much important. So you can go to my YouTube channel and you can able to access the introduction to financial reporting. So we are going to look at the conceptual framework in isolation. To start with, we are going to look at the qualitative characteristics of the financial statement. When we are talking about the qualitative characteristics, these are the attributes that make information provided in the financial statement useful to users. We are looking at the content of information we are providing to the users of the financial information. So, what are the attributes? What are the features? What are the values of the information we are provided in the financial statement that will be useful to the users of the financial statement? So, this is very much important. We understand these qualitative characteristics. The characteristics divided into two main sections. We have the fundamental characteristics and we have the enhancing characteristics. So we need to aware of these two types of characteristics. So under the fundamental, we are talking about the relevance. Financial information is relevant if it helps to make an informed decision. If the financial information helps to influence the financial decision, then that particular information is considered to be a relevant information. So we need to look at the key, we need to look at information as to whether or what are the conditions for information to be relevant. This is the key aspect we need to know, and then we need to understand these areas. First condition is has the ability to influence the economic decision of the users. Now, for instance, if we are thinking about investing into a project, we need to have enough financial information that will able to help us in deciding as to whether we are going to invest or we are not going to invest. So we need these types of financial information that will help us to, to determine or to give us the ability to influence the economic decision of the users. So it is very much important also, for instance, if we are going to a contract with customers, we need that information. We need the due diligence test from the customer to ensure that we can able to go into business with the customers. We cannot go into business with the customers who has the propensity to become bankrupt, or let's assume that we have a customer who is currently facing some compliance issues with the government. So impliedly, we need to have solid information about these particular customers that will allow us to go into a business transaction with this specific customer. So this is the essence of relevant information. It should has the ability, it should have the ability to influence the economic decision of the users. That's the first point we need to know. The second point, the information should be on time. It is very much important. The time we are going to make the decision, short information should be available. So, we can able to use the information on time to help making short and informed and a strategic decision that will help the business to achieve its long-term goals and as well as its day-to-day operational activities. Finally, we are looking at materiality. which has a direct impact on the relevance of information. Now, for example, if we are planning to invest in $1 million project, we need relevant information to decide as to whether we are going to invest or not. Let's assume we want to invest in a project of buying a computer of $5,000. So if we are looking at the importance of these two information that is required to make the informed decision as to whether we are going to invest or we are going to buy a computer, you can't compare the information that is required for $1 million as compared to information of 5,000 leons. So we need to understand the concept of materiality. Also, when we are talking about materiality, it varies depending on the size of the item or the error judged, which is very much important. By materiality can be by amount or it can be qualitative. So we need to understand the aspects of materiality. Throughout the ACCA journey, we are going to discuss about materiality when we are going to audit and assurance, advanced audit and assurance, strategic business reporting. We are going to talk more about materiality. As I mentioned earlier, the $1 million project as compared to the 5,000 leons project, the $1 million is far material than the 5,000 leons project. So this is the concept of the quantitative materiality. So when we are talking about the qualitative materiality, for instance, if we are talking about IAS 24 and related party transactions, IAS 24 clearly stated that when there is an existence of related party transaction, we need to disclose that particular relationship in the notes to account. The relationship does not contain financial amount, but by its nature, it's qualitatively material to the financial statement. Also, if we are talking about IAS 37, the contingent assets and contingent liability, the standard, especially for the contingent liability, if it is, if it is remote or if it is not probable, it means we are going to disclose it or we are not going to do anything about it, either of the cases. So by its nature, it can be qualitatively material or it can be qualitatively material. So whichever, this information will help the business to make informed decision. Then that particular information is considered to be a relevant information. So now, information is material if omitting, misstating, it will influence the economic decision of users. We need to be aware of that. The most important thing about materiality is to whether as it will influence the economic decision of the users. Other than that, the information is not relevant. So we can't, consider that information in making that informed decision. Second aspect, we are going to look at the faithful representation. The faithful representation has three components that we need to understand. Firstly is the completeness. Information must have unnecessary description and explanation. The information about the $1 million should be detailed. You need to have the board approval. You need to have your Excel modeling. You need to look at the budget. You need to look at the forecast. You need to look at the investment appraisal. You need to look at the IRR. You need to look at the payback period. You need to look at your if analysis. You need to look at the sustainability of the project. You need to look at the cash flow of the company. In all put together, will give us a complete and the holistic information that will be used to make this informed decision. So information should be complete. Then also the information should be neutral, which is very much important. The information should free from bias. The cash flow should free from bias. The income statement should free from bias. The statement of financial position should free from bias. The budget, the forecast, the NPV, the net present value, the payback period, and the IRR. All of these information that you will be using to make this informed decision should be free from bias, which is very much important. Financial statements are not neutral if by the selection or the presentation of information, they deliberately influence the making of decision or judgment in order to achieve a predetermined result or outcome. Now, for instance, the company is planning to secure a loan, a long-term loan with the bank, which is very much important. In most cases, the company can do all what it takes, to secure this particular loan agreement. So in such a situation, the information we are going to provide to the bank, the information we are going to provide to the bank, whether we are going to provide our audited financial statement, whether we are going to provide a cash flow, whether we are going to provide, our forecast, our budgets to the bank. This information should neutral. It should replicate the exact information that is required to secure the loan. So we need to consider these features under the faithful representation. Finally, the information should free from error. Financial statement information should not have material error within the bounds of materiality. For instance, if we are talking about a $1 million project, the materiality, let's say anything around $100 or $10,000 material. We are going to look at the materiality threshold later in the future sessions. So with that regards, if the $100,000, it's material to the financial statement, it's material to this particular investing decision. So we need to ensure that, the error within the cash flow statement, the error within the forecast, the error within the income statement should fall below the materiality threshold. So we need to understand these three features. The second aspect, we are going to look at the enhancing qualitative characteristics. These features provide support to the fundamental qualitative characteristics. Firstly, we are talking about comparability. The financial information must be able to compare between years of company or industry. We need to use the financial information to compare year on year. For instance, we are going to compare the financial statement from the financial statement of 2025 to the financial statement of 2024. This comparability feature should exist between the company or between year on year. We can compare our financial information to another company within the same industry, or we can compare the financial information of the industry to another industry. So all financial information should have the comparability feature in it. Also, we are talking about the verifiability, which is very much important. Checking the inputs to Excel, we need to ensure we verify each of the transactions, each of the figures, and also each of the calculation. Or we can do some amount of observation, observing the process being performed. For instance, we are talking about the cash count, we are talking about other offloading method, taking inventory, the stock take and rest. So the verifiability, we need to ensure that the financial information is verifiable. And also we are talking about the timeliness. We need to ensure that the financial information is available on time so it can help us to make an informed decision. Also, we are talking about the understandability. The financial information should be presented clearly so that users can understand it easily. It's very much important because in most cases, when we are preparing our financial information, let's assume we are preparing our financial information about we are doing an age order analysis or we are doing our receivable aging. We need to ensure that this information is understandable. Everyone should understand the information. The customers that we are doing this particular analysis should understand the information we are presenting to them. So understandability depends on the way in which the information is presented and the capabilities of the users. So you need to understand, you need to present your information based on the type of users you are doing the particular information for. So now we have completed the qualitative characteristics of the financial statement. So now we are going to look at the elements of financial statement. Um, when we are talking about the elements of the financial statement, we are talking about the assets, the liabilities, we are talking about the equity, we are talking about the income, and we are talking about the expenses. So we need to look at the definition of each of these elements of the financial statement so we can able to use it in the future and we can use it in line with the IESs and the IFRSs as well. So now if we are talking about assets, this is the key area for students to understand. You need to know the definition of each element of the financial statement because when we are going to recognize these elements within the financial statement, we are going to use the basis of the definition to recognize or for us not to recognize this particular information. So when we're talking about assets, present resources controlled by an entity in which we are expecting a future economic benefit. It's very much important. The definition of an asset, has to do with the present economic resources controlled by an entity, not owned. We are talking about controlled by an entity. I mentioned it during my orientation session. If we are talking about the IFRS 15, sorry, the IFRS 16, the leases, within the lease agreement, you need to have the sole utilization, the rights to use the assets exclusively. There should not be an attachment within the lease agreement that is saying that you need to use this lease property for a specific period of time or that is telling you how you need to use that particular lease item. So you need to have absolute control. We are not talking about ownership in this situation. We are talking about the control. So the present economic resources controlled by an entity as a result of past events. The situation should have been in existence before we need to acknowledge this particular item as an asset or not. So what is an economic resources? It is the right that has the potential to produce economic benefit. Now, for instance, if we are going to acquire PPE, which we are going to use in the manufacturing process, it's obviously that you know, with the process of purchasing this particular asset, we are going to improve our production quantity. And if our production quantity is increased, it's obviously that our sales will increase as well. So if the item that we are going to buy increase the production process, increase the production output, then it means, it has the potential to produce economic benefit, which is very much important. So any asset that has the propensity to produce economic benefit, we need to look at it as economic resources. Now let's explain further about the definition of asset. Now you're talking about control by the entity. Control is the ability to obtain the economic benefits and to restrict the access of others. As I mentioned earlier, when I'm talking about the IFRS 16, it is very much important you understand that the controllability, should when you are going into an lease agreement, you know, for instance, I'm going to list the phone to you. Within the lease agreement, you told me that I should not use the phone after 4 p.m. in the evening till 7 a.m. in the morning. I'm only supposed to use the phone from 7 a.m. in the morning to 3:59 p.m. in the evening. So because of this condition, I'm not going to fully, utilize the economic benefits of that particular phone, that particular asset, that particular lease agreement. So it means that the controllability aspect of the definition is not met. So therefore, IFRS 16 is telling us that we are not going to recognize the rights to use assets and the lease liability as well. So we need to understand the controllability aspect of the definition of an asset. Also, the past event is the event must be past before an asset can arise. The situation should have been in existence before we recognize that particular asset. So now let's talk about reliability, which is very much important. And then we have lots of standards, that covered the issue of liability as to whether we need to, to recognize the liability or whether we need to disclose it or not. So now when I'm talking about liability, we are looking at the present obligation arising from the past event, which can result to outflow of economic resources. So for a liability, there should be a present obligation. There should be what? A present obligation to transfer economic resources as a result of past events. So you need to memorize, and you need to understand this definition. So now when you're talking about the present obligation, it can be a legal obligation, a contract, or it can be a contractual obligation based on past practice. We have been giving out, warranty to customers using our product. We have been giving out bonuses to employees at the end of the year. We have been giving out 13-month salaries to employees at the end of the year. So these are all contractual, and as well as constructive obligations. So we need to understand as to whether the obligation is legal in nature or if it is a constructive obligation. So whichever, we need to ensure that we start thinking about recognizing that particular liability. So now we are going to look at the definition in detail. Obligation. This may be legal or constructive. A constructive obligation is an obligation which is the result of expected practice rather than required by law, as I mentioned earlier. Over the past years, we have been giving out bonuses to employees, 13-month salaries to employees as well. So it is a usual practice by the company. So, impliedly, on annual basis, we need to make provision to ensure that we give out that particular bonuses or the 13-month salaries to employees. So now, also, the condition should have been in existence before we are going to recognize the liability. For example, when you're talking about leases, the lease contract will need to have been signed before the reporting date, which is very much important. We need to understand that. Also, if we are going to look at if we are going to look at IAS 37, which is provision, contingent assets, and contingent liability, we are going to look at technicality in terms of the present obligation and whether it is illegal or whether it is a constructive obligation, whichever obligation, and also backed up with the transfer of economic resources as a result of past events, then we are going to, we are going to make a provision, or we are going to recognize that liability. Now, for example, let's assume our financial year is the 31st of December 2025, or each year. Now, during November, we sold a product to customer, which has resulted to a court case. The customer has decided to take the company to court, and based on the invitation, and we consulted our lawyer as well. So based on the outcome of the sittings with the lawyer, the lawyer gave us a confirmation that we are going to, or we have 20% chance of losing the case. So with that situation, firstly, there is a legal obligation because it is a court case. So it is legally bind that we need to ensure that we are in compliance with the legal aspect of the court, because the customer, we have conducted business before, so it is legally bind. And then So if we are talking about the court case, the outcome of the court case, the lawyer will tell us as to whether, we are going to pay or we are going to lose that particular case. So if we are going to lose that particular case, it means that we need to know the amount, because we are going to look at it in details. Because to transfer economic resources as a result of past event does not only mean the transfer. We need to look at the cost that involve, the amount as well, and we are going to look at the probability or how possible that particular court case we are going to lose that particular court case. So we have a lot of things we are going to look out for, but for each standard, it has its own criteria and conditions. But however, all of these conditions as per IFRSs and IESs should be in line with the conceptual framework, should be in line with the definition of asset, with the definition of liability, the definition of equity, the definition of income and expenses. So now we are going to look at the definition of equity, which is the residual interest after liabilities deducted from the asset, which is very clear. Looking at our total assets, deduct our liabilities, so the remaining is the residual interest. Also, we are talking about income. Income is the increase in assets or the decrease in liabilities. That increase in assets or equity in any way. We are talking about expenses. This is a decrease in assets or increase in liability that reduce equity. We need to understand that as well. And most importantly, especially for strategic business reporting students, we need to look at the recognition and measurement criteria, which is very much important. We need to know whether we are going to recognize the asset, whether we are going to de-recognize the asset, whether we are going to recognize the liability, whether we are going to make provision, or whether we are going to disclose it in the notes to account, or whether we are not going to do nothing about it, whether we are going to recognize our revenue as per IFRS 15, whether we are going to recognize our expenses, depending on the IFRSs or IESs you are about to be implemented. So now let's look at the recognition criteria. It must be relevant and faithfully represented. So the first criteria for us to recognize an asset or liability, the information should be relevant. We have covered relevant in the previous slide, and also it should be faithfully represented. So this is the first condition about whether or not you need to recognize an element within the financial statement. Items are only recognized in the financial statement if they meet the definition of one of the elements of the financial statement. You need to note this point down. We are only going to recognize an element in the financial statement if it meets the definition of that particular element, the definition of the assets, the definition of the liability, the definition of the equity, income, and expenses. Also, for elements to be recognized, it must meet the relevant and faithful representation criteria. Recognition is not relevant if there is a greater uncertainty or low probability of inflow or outflow of economic resources. Now, as earlier I mentioned about the court case, if we have greater chance, let's assuming that based on the outcome and based on the report from the lawyer, we have 80% chance of winning the case. In that situation, the probability of losing the case is low. So in that situation, we are not going to recognize a provision at that point in time because we have 20% chance of losing the case and 80% chance of winning the case. So in that situation, we are not going to recognize a provision. We are going to ensure that we disclose a contingent liability. And when we are going to talking about IAS 37 provision, contingent assets and liability, we are going to look at these parameters that we are going to use as to whether we are going to recognize the liability, whether we are going to disclose it, or whether we are not going to do nothing about it. So for us to recognize an element within the financial statement, if there is a greater uncertainty or low probability, then we are not going to recognize that particular item within the financial statement. So it is very much important we understand these conditions. You know, for strategic business reporting students, you can use these conditions to answer to a specific question in the examination relating to whether we are going to recognize an asset or whether we are going to recognize a particular transaction in the financial statement. If there is a high degree of measurement uncertainty, if we are finding it difficult to calculate the amount that will be incurred, the amount that we are going to, or that will be the inflow or the outflow of economic benefits. If we are struggling to know that particular amount, then it is very much important that we are not going to recognize